Welcome to the latest episode of Brooks Macdonald Podcast. I am Priscilla Cheung, investment specialist, and today I'm joined by our Chief Investment Officer, Will Hobbs.
Hello, Priscilla.
Hello, Will. So for the past few weeks, markets are doing really well. We're seeing pretty much all-time highs every single day. But despite, the very positive headline levels, I can't help but to feel a bit nervous. It seems like everything is going, maybe a bit too well. I'm thinking maybe, could this be a repeat of the 2000 dot-com bubble, or maybe something even more sinister like the global financial crisis? What do you think?
My word, Dr. Doom. Let's keep it light, Priscilla. I think, it's a nice sunny day.
I just want to keep it real. To be honest, I've been traveling quite a bit across the country, seeing most of our clients. And I think a recurring theme is that should we be a bit more worried? Right, even though at the headline level, yet again, markets are doing relatively well. I know you covered quite a bit of the bubble stuff with Pippa last time in the last episode. And the long story short, the headline news is that even though valuations are pretty demanding, but in terms of fundamentals, it's still relatively good. So basically, it's different this time.
You're hitting all the things that are going to make everyone nervous. Those are meant to be the four most dangerous words in investing, aren't they? I would say just pedantically, I think that in a way, it's different this time and not the most dangerous words in investing. It's always different this time. Subtly, sometimes profoundly, but yes, I don't want to alarm anyone. And I would make a couple of points, I guess. So, first, in a way, and you're right, framing the market as you do, it's very interesting way to think about it. There are a lot of moving parts, but bond yields moving up, so interest rates across the curve and stocks moving up at the same time, particularly when you look at some of the constellation of moves below the surface, both in the bond market and the stock market, you would actually argue that this is the world's investors upgrading global growth expectations. Now, there's definitely areas of froth in all of this, and they don't have to be right, but yeah.
Yeah, speaking of froth, I think in terms of, say, for example, memory chips stocks, it feels like everyone is trying to get a piece of the cake.
Yes.
I was reading somewhere that there's this leveraged ETF in semiconductors. In terms of inflows, the fund size has doubled in just the last month or so. And I guess the point is that, even though the signs of exuberance is quite different from 2000, point taken in terms of valuation, and this is especially true in terms of fundamentals as well. But yet again, we're starting to see some more corporate activities, even though it's not all that similar to the really weird stuff that was going on in terms of M&A back in 2000.
Yeah, remember that back in 2000, and obviously you're too young for all of this, but there was the merger of, the weirdest one was the merger of a sewage and media company. That may not sound that weird to some people today, but actually, that didn't obviously yield the synergies in the cold light of the crash aftermath that some of the more optimistic people had suggested. Just to sort of play on this a little bit, because I think, in the what could go wrong frame of mind, there are things that we do worry about. It's not that we're not worried about anything, but some of the worries that we have, I guess, are pretty familiar in terms of where we are in a kind of cycle of technological change. They're more related, I guess, to what the actual utility, the actual potential of this new batch of technologies turns out. So, we know that, AI, and I'm talking very broadly here, the purists will say that there's all sorts of different things covered by that term. It's automating not muscle, but, the cognitive outputs themselves. So from writing to coding, it often performs these tasks quite well, as we know, but because it can be confidently wrong, in ways that look plausible, it's also potentially quite dangerous. So there are still going to need to be, in many of the more sort of important tasks, humans to verify the output. And there's a really good example the other day, where there was a Manhattan bankruptcy court and provided, like I say, this illustration. So it's Sullivan and Cromwell, one of Wall Street's most prestigious firms. They filed an emergency motion that turned out to be riddled with fabricated citations and all sorts of other AI-generated errors. The mistakes were not caught by the firm's own review process, but by opposing counsel, which was obviously a little bit embarrassing. But it shows what happens when a tool that produces fluent output meets a world that demands kind of verifiable truth. And this is the challenge, I think, with what is still a jagged frontier in terms of AI capabilities, and you're still getting these hallucinations and mistakes, is the further up the chain you deploy it, a chatbot that hallucinates, a paragraph is annoying, obviously, but an agent that changes code, moves money, files paperwork, deletes a database, or triggers actions across systems, that can create real damage at machine speed. So that's just one of the things I guess we're worrying about a little bit, and we just don't know which problems are going to be solved and which aren't.
Yeah, I agree. There are definitely issues, but at the same time, more positively, I think we are seeing some productivity growth. Say, for example, at a more industry level, we're seeing self-reported data as well as experimental studies that point to we're seeing productivity growth coming out from AI, from the adoption of AI. But at the same time, I think most of it is still more or less qualitative instead of quantitative. It's very difficult to pinpoint an exact number.
Yeah, we're always going to be guessing a bit at this stage. And I would actually probably say that some of the productivity statistics we've seen, so the efficiency gains we've seen so far in the economy, I think they're probably not necessarily all associated with AI per se, but more kind of machine learning and some of the other breakthroughs that we've seen around the information revolution. And I think also we probably need to keep in mind, I've got a small boring story, which is one of my favorites, about how to think about process change. And this is with electrification. And this was a guy called Paul David, an economic historian, was talking about how, during electrification in the 1880s, you already see, electric motors widely available, but you don't see any productivity gains. Bear with me. And actually what happens is that at the time, the factories obviously have these giant kind of steam engines in the basement and a huge pipe going up through the factory, and you've got lots of fan bolts and pulleys and so on rigged off this to the various machines. So what they do in the first instance when it comes to electrification is they just switch one power source for another, and you don't really get any productivity gains. It takes them to realize, the kind of next generation of factory managers, that actually what you needed was lots of little electric dynamos that you could attach to individual machines, making the factory much safer, but also being able to then reorganize the factory in a more logical way. And therefore you get assembly lines, the Ford production mode, all of that kind of piece. And that's when you get like supercharged productivity as a result. And I think, the timeline may be a bit more accelerated this time. But keep in mind, I think, that the revolution goes well beyond AI, and it's about rearranging processes in the knowledge economy, which again is what the UK is big in. That's one of the reasons to be bullish medium term. But it's also about better pattern spotting, communications, computing power, all those things, and how they interact, in my opinion. So I'm probably a little bit more skeptical on AI as it stands, but more positive on productivity overall, just to sort of...
Can I just also get your thoughts on the latest earnings seasons, because these are the hard numbers that we're getting out of these companies. Say, for example, NVIDIA, their results are actually pretty good, very good growth numbers, and also broadening customer base. At the same time, we're also seeing surging capex leading into 2027 as well. So it seems like all is fine. Is it fair to say that?
Well, you follow these things closer than I do, Priscilla. So, I would very much take your word for it. But yes, from what I see and from my kind of, macro perspective, what we saw was still very strong earnings growth. There are some sort of question marks you can have over sustainability of some of it, for sure. But the thing that I was looking for, I guess, was kind of the broadening out of earnings growth. So it's still the story very dominated by these mega corporations. I've written an article about it this week, actually, which we'll put out on LinkedIn, about that sort of competition and how much this world is dominated by those corporate titans. But yes, overall it was an encouraging earnings season, and that's part of the reason why you've seen this kind of next leg up in markets, is that and that sort of that growth revision we talked about earlier in markets was in part driven by the fact that people are now getting a bit more confident, I think. Yeah, in how these in the outlook. But yes, did you agree? Is your sort of
I would largely agree with that because if we just look at earnings revisions as well, I think the term that we've been juggling with is potentially there could be an earnings recession.
yeah?
But it seems that that is not materializing, at least not in the short to medium term. And with that, we don't sort of foresee a broader based recession at all.
Yeah, that would be nice. It would be nice to not have a recession.
Yeah.
I mean, in a way, back to your opening about sort of, the potential for recessions and all of these kind of things. I mean, it's a little bit fiddly again, but when I think about it, if we could, you and I, reliably predict recessions, they wouldn't exist. The reason I'd say that in a way is that just thinking logically, it wouldn't just be you and I jumping out of the way on behalf of our many treasured clients. It would be businesses, consumers, governments, so much so that if everyone jumped out the way, then they wouldn't exist. And funny enough, there is a book I was reading, and the title will give you a sense of just how boring I am. It's by a guy called Tyler Goodspeed, and it's called Recession, The Real Reasons Economies Shrink and What to Do About It. It's obviously not going to be outselling the latest Jack Reacher in the airport shelves, but this guy, Goodspeed, he studies business cycles going back to 1700. Obviously, on this point, we've got to be a little bit wary because, a lot of the statistics we're kind of measuring the economy badly with today, they only really originated, 1970s, the earliest, let alone back to the 1700s. But a lot of the sort of the cycle idea is quite credible, I think. Anyway, Goodspeed, and this is really important for our discussion and just for investors generally for how to think about it. I always think when we're thinking about an economic cycle and the evolution of the economy, we always sort of conflate it with our own ideas of aging. So we have some sort of biological clock ticking, and ultimately, just like me, your hair falls out, you get chubbier, and then the end is nigh. However, Goodspeed shows that British and American expansions do not die of age under the hood as such, or do not age under the hood, so showing accumulating bad investments and distorted decisions that make a correction ultimately inevitable. So for that to be the case, you would expect that expansions, as they get longer, they get more likely to end. However, in his data, which I think is quite intuitive in a way, the relationship between age of an expansion and the probability of death of a cycle is essentially zero. So nor do measures of increased investment during the boom correlate with the severity of a downturn, nor do longer expansions have longer recessions after them. There's almost no relationship whatsoever. And this is why recessions, to your point, remain essentially unpredictable. Any perceived regularity is likely to be a statistical illusion. And as you know, I think this is a real problem in investments and economics. I'm sorry, this has turned into a long rant, but I've got to have this rant because it's a real problem in investments and economics in particular, is that we are inveterate pattern spotters, human beings, who really thinks that constellation of stars looks like a plow or any of the other, bits and bobs. And we've obviously deployed, in generative AI, this kind of lapdog pattern spotter. But quite a lot of the data we're dealing with here, it just doesn't really provide the scope for these patterns. They could just be sideshows to a degree, misleading to an extent. And that gets back to that AI point a little bit. It's not very reassuring, but I think it does make us think a little bit about, as investors, we're going to not be able to predict many of the bumps in the road ahead. We can be diversified, we can be careful, we can be, big on due diligence and make sure that, all of the resources of the firm are deployed to making, sensible investments. But ultimately, there'll be stuff that comes along that we won't be able to predict. So there's a degree to which we've got to try and make as much money in markets where we can, balanced with the idea that we've also got to make safe investments and make sure that we're diversified so that when things do go wrong, inevitably at some point.
I completely agree. I mean, in terms of previous recessions, they all look so obvious in hindsight.
Yes.
How could we have missed those? But I can't help but to draw some parallels here. I know we talked about the TMT bubble, but what about the global financial crisis? Right. Yes. At that time, we had a lot of leverage that is sort of invisible, embedded in the system. And of course, we also had sort of a faulty assumption that, the real estate industry, the sector just cannot falter Is this sort of implicit assumption sort of embedded in the AI trade as well? The mega caps, they just cannot falter.
Yes. It's funny, isn't it? And you're so right. I mean, in a way, like quite a lot of where markets can go wrong is that extrapolative piece where you just see something for so often, your lived experience is something that goes in a certain direction for so often that it becomes almost impossible to imagine that it would go in the other direction. And I think that is something just to bear in mind with regards to cycles. Just one point though on the securitization bit. Again, I was reading another phenomenally boring book, not to me, but to anyone who has a sort of, a decent life to do stuff with. And it was about sort of the savings and loan crisis in the US in the 1980s. And this was when a lot of the sort of mortgage activity or house purchase financing system in the US was quite locally based. And so you would have individual institutions which were in charge of funding mortgages in that area. And so when you found quite a lot of problems in that period resulted from that geographic concentration of loan risk and so on. And so one of the innovations that came out of that was securitization, because actually then you were able to spread risk around the economy, allow more people access to mortgages at lower interest rates. So it was part of the sort of, that was maybe the birth of what led us up to in 07, 08. But it shows how something benign can ultimately turn into something, to metastasize into something much nastier. Again, though, I would say also that while you're right about some of the aspects there, I would caution against turning these things into morality plays where certain actors misbehave, even though there was certainly that as well, and they get spanked by a kind of just force out there to punish our vices. These major downturns often are frequently, yes, bits of hubris, but also sometimes kind of overlapping what's called exogenous factors like COVID and various other things. Or even, war, or even in 1873, it was a plague of locusts, literally biblical. But these sometimes reveal vulnerabilities, but it's possibly a bit more random and less predictable than the morality play idea sort of sometimes argues, I think.
I also absolutely agree, but at the same time, I am seeing a level of vulnerability in the current world that we're living in. Partly because just the sheer volume of debt that we have. That is true for most governments in the world, for the UK government, for the US government as well as in the private credit, private debt space.
Yes.
What do you think of that?
Oh, yes. I mean, I'm going to sound really crazy here. Private credit, a little bit something different. I mean, in a way, private credit is not new, is it? It is one of the oldest asset classes in the world. The government debt piece, I do think the IMF is unhelpful here. There was an old boss and mentor of mine kind of very much hammered this into me early on about double entry bookkeeping. And it was really the idea that Earth, the planet Earth, cannot be a net debtor. All of its assets must match its liabilities unless the evil bankers have managed to syndicate debt intergalactically. And I'm sure there is some unfortunate Martian microbe about to be sold some subprime mortgages as soon as we find them. But until then, Earth's assets must meet its liabilities. And so the sum of global debt is not that interesting a thing in many ways. And actually, in the UK's case, the UK has had way more debt to GDP in the past, and it's not been a problem. It's not been related to growth. In fact, I think when the UK had just beaten Napoleon, 1815, we had debt to GDP of 250%. That was down to 25% of GDP, roughly speaking, by around 1900. But that period was also one of the fastest periods of living standards, growth, because it was the Industrial Revolution. And so in a way, I just think a lot of the problem we have with debt is a hangover from the great financial crisis and a misdiagnosis of what went wrong. It was, I think you mentioned this, it was a liquidity crisis, not a solvency crisis. Suddenly, we were unable to trust what was in someone else's balance sheet, and that created a kind of heart attack from which a lot of other problems flowed, but that may not be a popular view.
Right, but it's not just about the volume of debt, it's also about the cost of debt.
Yes.
I mean, interest rates are there a lot higher than what we're used to post global financial crisis. Well, of course, we're way down from the peak just around 2 years ago. But at the same time, since the start of the Iran war, I think interest rate levels will probably go up from here once again. Do you think, in terms of the cost of debt, that would put a lot more strain on the overall economy?
Potentially, but not. So in some way, I would say that some of the rise in interest rates is explained by the fact that the economy is growing a bit faster. And that's true in the US and the UK. The UK, some of the statistics may have some catching up to do. I suspect, though, that the UK has been doing a bit better than feared for some time. It's just our statistics agencies are in quite a terrible state at the moment and are struggling to pick it up. But a lot of the anecdotal side and looking at the kind of HMRC data a little bit closely does suggest that the UK is doing better also. And that will be key to defining how sustainable the debt pile is. I mean, I think we mentioned it last week or the week before, but yes, if you assume that the UK, for instance, is never going to grow beyond 0.5% again, the GFC, post-GFC Great Financial Crisis average, then debt does become a problem. However, if you assume that actually the post-Great Financial Crisis was the blip and the trend is more likely to be the one that we've seen since 1940 up to the Great Financial Crisis, about 2.5% real, then the debt can almost disappear as a percentage of GDP in 50 years. So it much depends on sort of what range of possibilities you assume about the future and how you think about it. So it's not that no debts are a problem, and it's not that the level doesn't have to be a problem. It can be, and it can force chokes. But yes, I also think maybe that these higher interest rates are part of the productivity story. So you can have something called the cleansing effect, which actually sort of cuts away dead or dying corporate flesh in order to make space for new ideas and new businesses to, there can be an uncomfortable process societally, but it can also be helpful for the overall economy. So just some more positive attempts.
While we're on the topic of interest rates, I think I do have to bring inflation into the picture.
Oh gosh, yes.
I'm sure for a lot of our listeners as well, the stories of 2022 is still very fresh. I know we can't draw direct parallels, but yet again, there are some lessons there, right? Because 4 years ago, there was the Russian invasion of Ukraine, and now we have the Iran war. Are we going to see inflation to be a bit more entrenched in the market, and potentially we could see another rate hike cycle? What do you think of inflation?
Yeah, difficult. I mean, I don't think as a species, and this would include central bankers and all professional forecasters, that we're very good at forecasting inflation. The industry's got a long and not very glorious track record on this front. We still don't really understand how inflation works, and the reason for that, in a sense, is that quite a lot of the transmission, as you know, is psychological. It's about how we, as individuals, update our expectations on the back of a price shock, that's how it kind of metastasizes into something nastier. I would say, though, that some of the conditions that were present in 2022 aren't present now. So in particular, one of the ways that it can transmit is, very tight labor markets. So lots of people looking for, not enough people looking for work, and lots of jobs trying to hire people. And so bargaining power is very much on the side of the workers, and therefore, that can push wages higher. That's not quite what we see at the moment. There are debates on this, and again, the data is so poor. The data are so poor in this space. We're flying a little bit blind. And I would say that in the US, there are concerns a little bit more with this kind of net migration story because of the kind of ICE raids and all the big migration push. You've, potentially going to this year, I think, negative 1 million in terms of migration flows. This is Brookings Institute, data they keep tabs on. So that might be a bit of a problem. What people are pointing out, though, is that in peak, sort of when President Biden kind of opened the doors, or was perceived to open the doors to the country a little bit too much, you saw, I think at peak, around 3 million net migration. That's versus the run rate of 1 million, roughly speaking, usually. So, that suggests that the stock of migrants, therefore the overall workforce, has still got a little bit of that to absorb. And interest rates are already a bit higher. So keep humble, I think. And the translation, as you know, is not quite what we think it is. So in terms of food prices, you can find that lags, that what we experience in the supermarkets lags what you see in sort of, quoted food prices in a sense by almost a year sometimes. And because we live in kind of economies where energy prices are quite heavily regulated, you can also see that smoothed out. We may not see it till July, August, so on. So yeah, it's definitely something to watch for, but I still see more disinflation in the medium term versus inflationary threat.
Right, so just bringing everything back home in terms of the UK, I'm sure inflation, yet again, is a bigger concern here versus in the US. And at the same time, we're also dealing with potentially higher bond yields. And this is partly due to the political climate here as well.
Yeah.
I think the PM's position is probably less secure than it was a year ago. What do you think of that, especially politically in the UK?
Yes, it's difficult, isn't it? And now you see the problem you have is kind of like there's quite a strange mismatch between a campaign for a very, very local election. And obviously, this is where Andy Burnham is trying to he's saying all the time that he's trying to keep it focused on local issues, but it can't help but be broader than that because everyone is watching that what happens, what he promises here could translate into policy in Downing Street before too long. So it's a complicated moment, but I would say ultimately that, quite a lot of what you can say on the campaign trail is quite unconstrained. Whereas when you get into office, whether you like it or not, you're sort of shackled by commercial reality to a degree. Yeah, it doesn't have to be sinister in a way. These are one of the sort of constraints that you see on policymaking in the US and the UK and in many developed economies, which is that, bond markets aren't political per se. Most bond investors, and we're included in that, everyone listening to this podcast, watching this podcast will all be also bond investors lending to the governments in various guises through pensions and so on. Most of us, we just want our money back at the end of the term with the minimum of unexpected inflation to get in the way. So you need a degree of credibility, of grown-upness and all of those kind of things, maturity, I should say. So like I say, you can talk about the shadowy forces of finance to your heart's content on the campaign trail, but ultimately, as we found with Prime Minister Truss, a slightly different context as well, that the bond market can provide a policing influence. We shall see. The UK is in an interesting place politically at the moment, isn't it? I mean, we seem to be going through prime ministers at quite a clip.
Thank you so much, Will, for the insights. I think the key takeaway from me today is that there are always risks out there. There are always plenty of reasons to worry, but very few real risks announce themselves in advance. It will all feel a lot clearer with the benefit of hindsight in the near future, I think. So thank you so much for tuning in today. We'll see you soon.